Finance with C.A. Sushant Singh. Equity investment. Equity represents an ownership interest in the company. Common shares, also known as equity shares, these are the residual claim that is after the claims of debt holders and preferred stockholders on firm assets if the firm is liquidated and has voting rights. Firm is under no obligation to pay dividends on common equity. Common shareholders are able to vote for the board of directors on major decisions. Callable common shares. Callable common shares are shares of common stock that the issuing company has the right to repurchase from investors at a predetermined price, often at a premium to the market price. This feature is more common with preferred stock but can also apply to common stock. Essentially, it gives the company the option to call back the shares, potentially limiting the upside for investors if the market price rises significantly. Putable common shares. Putable common shares, also known as putable stock, are common shares that include a put option, allowing the shareholder to sell the shares back to the issuing company at a predetermined price, the put price. This put option acts as a form of insurance for the investor, protecting them against significant price declines. Preference shares. Preference shares, often referred to as preferred stocks, are a type of share issued by a company that provides certain privileges to the shareholders. Unlike common stockholders, preference shares holders are entitled to receive dividends before the common shareholders. In the event of a company's liquidation, preference shareholders are paid before equity shareholders but after debt holders. This type of share is primarily issued to raise capital for the company. While the dividend on preference shares is fixed, the shareholders typically do not have voting rights in company decisions, which distinguishes them from common equity shareholders. Cumulative preference shares. Cumulative preference shares allow owners to receive cumulative dividend payouts from the company even if the company is not profitable. In years when the corporation is not profitable, these dividends will be reported as arrears and will be paid in full when the business becomes profitable. Participating preference shares. Participating preference shares receive extra dividends if firm profits exceed a predetermined level and may receive a value greater than par value of the preferred stock if the firm is liquidated. Non-participating preference shares. Non-participating preference shares are a type of share that entitles the holder to a fixed dividend, but they do not participate in any additional profits or surplus assets beyond that fixed dividend. Essentially, the holder receives their predetermined dividend, but does not share in any extra profits the company might generate beyond that, nor do they share in surplus assets upon liquidation. Convertible preference shares. Convertible preference shares are a type of equity security that combines features of both preference shares and common stock. They offer investors a fixed dividend like traditional preference shares, but also provide the option to convert the shares into a predetermined number of common shares, usually after a specified period or upon the occurrence of certain events. This conversion feature allows investors to participate in the potential upside of the company's common stock. Depository receipts. Depository receipts represents ownership in foreign firm and are traded in the markets of other countries in local market currencies. A bank deposits shares of a foreign firm and then issues receipts representing ownership of a specific number of foreign shares. Sponsored and unsponsored DR. If the firm is involved in the issue, the depository receipt DR is a sponsored DR. Otherwise, it is an unsponsored DR. A sponsored DR provides the investor voting rights and is subject to greater disclosure requirements. In unsponsored DR, depository bank retains the voting rights. GDRs. GDRs are issued outside the United States and the issuer's home country, denominated in US dollars. It allows companies, particularly from emerging markets, to raise capital from global investors by offering their shares in a foreign currency, like USD or EUR, on exchanges outside the US. ADRs. An American depository receipt is a certificate issued by a US bank that represents shares in foreign stock. These certificates trade on American stock exchanges. ADRs and their dividends are priced in US dollars. ADRs represent an easy, liquid way for US investors to own foreign stocks. Book value of equity. The book value of equity represents the net asset value of a company, or the total value of its assets minus its liabilities, as recorded on the company's balance sheet. It essentially reflects what shareholders would theoretically receive if the company were to be liquidated after all debts are paid. Market value of equity. It is the total value of a firm's outstanding equity shares based on market prices and reflects the expectations of investors about the firm's future performance. Return on equity ROE is Return on equity ROE is a measure of a company's financial performance. It is calculated by dividing net income by shareholders' equity. Because shareholders' equity is equal to a company's assets minus its debt. Thanks for watching. Please do subscribe and like the channel.